Like it'll be two to go into.
Good evening, everyone. Thank you so much for being here. I know there are plenty of other things you could be doing, except you're showing interest in us, and we really appreciate that. Our junior analysts have, I'm sure they will admit, have put in a ton of work and time into this, and I know they're really excited to share it with you. Before they start, I want to give a little brief intro about the group. For those of you who aren't as familiar with us, well, in a second. Oh, well. All right, I'll just use this. There we go. So even though we are a group of SMU students, we are not technically an SMU student group. We are a nonprofit organization, fully registered in Texas, board of directors, all the great stuff. We donate any investment-related gains back to SMU and back to scholarships. So many of the students in this room might be BBA scholars. You could argue that in turn, a portion of our donation is essentially funding your scholarship. And for us, it's really unique and really rewarding. We currently manage around 300 grand of our own money, pure long equities. And we also advise on the student senates just under $1 billion right now. You can only join the group as a freshman or sophomore. And so for those of you who are freshmen, thank you for being here. We've got your email. We'll reach back out when you're a sophomore. But this is an awesome opportunity to see what the group does firsthand. Touched on donation, education, obviously this is a result of the hard work they've put in, but we really stress placement a lot, not only within Cox, but outside of Cox. We enjoy a great relationship with the ALTS program. That's the honors finance program you take when you're a junior. But then we also stress professional placement heavily, and year over year, our alumni network grows, and we're extremely thankful to enjoy a great relationship with our alumni. So what you're going to see tonight is stock pitches from our junior analysts. These are freshmen and sophomores who just joined the group back in August. So 3-4 months ago, they've learned, they started with a blank slate and they've learned the entirety of SMU's accounting and finance curriculum in just 3 or 4 months. We say a year, but we've already taught them all. And we're going to teach them a little more complex stuff in the spring, but they've learned essentially everything. And we've also taught them how to use Excel, how to use PowerPoint, how to do those valuation methods in Excel and turn them into these beautiful presentations you're going to see today. And it's extremely impressive, and it's really, really proud of them. These are just, I'm going to kind of switch back and forth. The first 2 pitches we did back in September and October. So shout out to the energy team, Noble from pitch 1, and shout out to the consumer team pitching Lifetime, pitch 2. This is like, I joined 2 years ago, and these presentations and the quality just runs laps around where the group was 2 years ago. So it's really unique and exciting to see the growth of the group, and we're excited. I'm really excited to see where it's at in 5 or 10 years. So last thing I want to touch on is recruitment, both us recruiting freshmen and then our members recruiting to get real jobs. So for those of you who are freshmen, I applied when I was a freshman to Big and didn't even get an interview. And so I did the freshman pitch competition in April. We're going to have it this April again. It's a great way for me to present in front of the group. Hopefully then when I applied in the fall, they remembered my name, put the name to the face, and hopefully, I think it worked well with the application. And so shout out to Will and Drew for winning back in the spring. They took home a $2,000 prize, and while they both got into the group, they weren't guaranteed getting into the group, but they were guaranteed an interview. And so it's a unique sort of motivation for the freshmen. We certainly encourage you to apply in the spring. Then once you're in the group and you're a sophomore, we do a New York trip. While we absolutely enjoy our relationship with the Dallas employers who are here, and we're extremely thankful for that, we also bring the sophomores to New York. And this year we visited an absolutely amazing group of firms, and many of these banks actually hosted, this is the first time they ever hosted SMU students into their firms for tours. And so we're very excited to enjoy that relationship with the firms. And without further ado, we invite all of you to have some sort of skin in the game tonight. This QR code on the left, highly encourage you to rank the pitches. It's just sort of a 1 through 5, which pitch you thought was the best, the worst. Asking you a question, why did you think this one was the top? Why did you think this one didn't do so well? And then on the right, I know it might be hard to see with the glare up here, so feel free to scan for the actual master PDF of all of the pitches tonight, and feel free to put up on the computer. So I'll give you all another minute or two. I believe energy is first up, so y'all can feel free to come up here. We'll give them another minute or so. But thank you so much for being here. I will mention that we're going to have 5 stock pitches across 5 different sectors. So we're going to have 3. We're going to have 3 right now, and then we're going to take a 10 or 15 minute break, go get a water, snack, say hi to everyone, and then we'll come back and finish the last 2. So thanks again. Really looking forward to tonight. Okay.
Good evening, everyone. My name is Colin Behrens.
I'm Andrew Bresh.
And I'm Doreen Issa.
And today we're very excited to present a long recommendation on Fluence Energy. Just before we get started, I want to give a huge thank you to Sebastian and Thomas for all their help throughout this pitch, and a huge thank you for everyone coming out and supporting us here. So today we're kind of going to be hitting on our industry and company overview. We're going to follow that with our investment thesis and our risk, and ultimately end up on our valuation. So without ado, let's go into our industry overview. So looking at the industry overview, the grid today was not built for today's electrification, renewables, or rapid AI load growth. And battery energy storage plays a vital role in this. They solve 3 core solutions, and that's storing excess energy, shifting energy across time, and stabilizing the grid through large AI growth. And we've seen a huge growth in behind-the-meter demand through these data center projects. Now, this is where battery storage solves a vital role. They stabilize the grid, and also they reduce grid strain as well as costly upgrades.
Looking deeper into Fluence, they deliver these solutions through 3 main operations: their hardware products, which is the physical battery, their service contracts, and their AI-driven software applications. Through their strong delivery platform, they have been able to maximize their gigawatt deployments, bolstered by a $5.3 billion backlog. Their market positioning as a major player stems from their moat, which is fueled by their Fluence IQ optimization and their data advantage. Additionally, Fluence is vendor agnostic, meaning that they can attach to any hardware or software from any other vendor, allowing them to scale their operations effectively.
Now, looking at the stock performance over the past 12 months, stock has recovered significantly from the low set in the first quarter, just coming off threats of an SEC investigation and lowering of 2025 revenue guidance, but has risen in the second half of the year, coming off the growing backlog and AI and data center tailwinds. Now, looking at the investment thesis, we believe that Fluence's backlog is currently being undervalued. In 2025, they were only able to convert about 51% of their contracted backlog into revenue, and investors are worrying that this may be the new norm. But if you take a deeper look into what actually happened, that other 49% was not canceled. It was simply pushed onto 2026's revenue conversion due to some execution challenges. I'll note that customers in contracted backlog have never canceled in company history, and the delays were only due to some legislative changes and supply chain constraints. Fluence has historically converted revenue at 93%, and we believe that is more fair number to use. And I want to look at some benefits of having a growing backlog. Fluence's backlog has grown 80% over the past 2 years, with digital applications growing 75% in the past year alone. The revenue mix is incrementally shifting into these higher margin segments as backlog grows, and that's because they are implementing service contracts into over 90% of their new contracts that last for 10 to 20 years, with service annual recurring revenue growing 50% in the last year alone. Overall, this is shifting the company from more of a project-based integrator to a more recurring revenue platform as backlog is growing and it's shifting into those more higher margin segments of the business.
So looking into our second thesis point, now if we look into the merchant storage revenue capacity, it's mainly dominated by algorithmic optimization and not necessarily hardware. We can see that in the CAISO and the ERCOT markets, just the California market and the Texas grid market service. And those are dominated by ancillary services and not necessarily hardware. If we look at the data scale advantage that Fluence has, they outpace their peers in algorithmic optimization fleet by 5x. And what that means for Fluence is once they have more assets, they get more accurate optimization, leading to customers from these other peer sets going over to Fluence, gaining them more accurate assets, gaining even more accurate optimization. Now, looking into their optimization influence, it's rapidly growing, and we see Fluence taking advantage of this through their increased fleet size and really capitalizing on this. So even though Fluence is being viewed as a low margin hardware integrator from the street, we see it as a software driven market maker.
Looking into our third thesis point, Fluence has created another advantage, and that being having the first ITC compliant product, which is GridStack Pro. GridStack Pro meets the ITC domestic content minimums, meaning that Fluence customers have a 10% added tax credit, which their competitors cannot offer. Additionally, there's an unrealized market for GridStack Pro. Because data centers are facing interconnection congestion, meaning they cannot scale with hyperscaler load growth, they need a joint solution. That being behind the meter storage, which is what they now rely on, and front of the meter storage, which is what GridStack Pro can capitalize on. And Fluence has fully integrated their US supply chain to stay ahead of the rising ITC domestic content minimums, and have recently added an American-controlled cell supplier because of the gray area within foreign entity of concern regulation. However, their competitors are still heavily reliant on Chinese imported lithium-ion cells, meaning that Fluence still has the domestic content advantage.
Now, looking at some risks that investors might be worried about, we see the first and foremost risk of regulation. Regulation changes have the ability to upend any business, especially in a competitive market like we see Fluence operating in. They hedge against this risk by being diversified in over 40 markets and also adapting to regulatory and legislative changes rather quickly, like we saw this year with the Big Beautiful Bill and the domestic content minimums. Then the next risk we see pressing the business is the execution challenges, which investors definitely do not want to see a repeat of what happened in 2025. So Fluence has been able to mitigate this by, say, their US integrated supply chain. Hardware commoditization and digital layer competition also pose a threat to the business, but they're not as significant as the other two.
For our comparable companies analysis, we chose these comps to get the full spectrum of how the market values energy hardware, software, and integrated power packs. As you can see, Fluence has extremely high revenue growth, but trades at a low EV to revenue multiple, showing a clear disconnect in their valuation.
So looking more at an intrinsic valuation of Fluence, we model in digital applications as well as services compounding faster than the street expects as that fleet size grows within the next 5 years. On the cost basis, their COGS have a 97% correlation with the forecasted battery pack prices, which serves as a viable proxy for forecasting out their COGS within 5 years. Across both sensitivities, we see meaningful upside and showing as their revenue mix transitions to more of a higher margin in those services and those digital application fleets. Summing it up, we see multiple paths towards a re-rating for Fluence within our hold period. And that is because their backlog visibility is transitioning as the execution issues normalize. As Fluence is transitioning more into a software-driven market maker and not being viewed as a low-margin integrator. And third, as its ITC compliance serves a clear advantage and gives Fluence the ability to win utility-scale bids. We thank you guys for your time. Now I'll open the floor to any questions you might have.
Talk a little more about who their customers are, if there's any customer concentration, and then like what their kind of sales pitch is to those customers over some of their competitors.
Definitely, yeah. So they do have a little bit of customer concentration. Their main two customers are Siemens and AEG, and those historically used to be around 80% of their revenue, and currently it's now 40%. So they are trying to de-risk that risk of having all of their revenue coming from those services. And their main pitch is that they've had 15 years of history of being able to become an integrator within these US systems. And not a lot of other places have been able to have that success within the US and also win these utility scale bids.
You guys, in your football field valuation, decided to weigh a sum of the parts model. Can you walk me through some of the logic in doing that?
Yeah, definitely. So the basis for that is we kind of just wanted to see what it was like for all of our projected forecasted revenue they had for each segment. And due to that, we wanted to value each segment based on that. So we felt like it was viable to do just because their segments are, somewhat different. So kind of to have more of a holistic approach, we use that some of the parts comments.
I'll add, I forgot to mention this earlier. We would please welcome anyone in the audience to ask questions for any of the pitches.
What do the gross margins look like in their like software versus hardware segment? Is that something that this reports?
Yeah, absolutely. So in their hardware segment, in the last year, they were about 12%, and then software is anywhere from, it's around 70% right now. So obviously much larger. It is a very small portion of the business, but it is growing again with all these 10 to 20 year service contracts on over 90% of new contracts. And with the growing backlog, it ends up being a larger and larger portion of the business.
So in thesis one, when you guys are talking about like margins expanding, you say like $1, like 1x service dollars are worth 2x hardware dollars in profit. Like
so service is about 24 to 30%. So that's a different portion of the business. Right. A lot higher than hardware.
You walk me through your valuation weightings, what's the rationale there?
Yeah, so the majority of our rationale, we've weighted a lot of our DCF just because we felt like it was a very viable option for this company. We really wanted to impact our thesis of these margin expansions. And we felt the majority of that was placed in our DCF. So knowing that information, we put majority of our weight through those EBITDA exit multiples, as well as our Gordon growth.
In thesis one, you guys talked about how this was kind of a one-time execution mishap. They cut the guidance for the revenue like 3 different times throughout 2025. What makes you think that right now is the bottom and we're going to see a turnaround in 26?
Right. So there were two things kind of going on this year that caused them to adjust guidance multiple times. And that was one with the big, beautiful bill and the tax credits with the domestic content minimums for their battery packs that created a supply chain bottleneck where they still wanted their customers to be eligible for these tax credits, especially on their larger scale projects where the tax credits would be many millions of dollars. So they wanted to make sure that they were sourcing domestically for their customers, and it ended up being most efficient to push those contracts till they could establish US supply chains. So that's where I really think it's a one-time thing. It was one piece of legislation that really altered their path in 2025. Wrong.
In your model, you guys built a bottom-up revenue build, which you guys ended up weighting. And then you also built the top-down. And when you flip between the two toggles, valuation changes pretty significantly. I was wondering if you guys could kind of walk me through the rationale for each and why you ended up going with bottom-up instead of top-down.
Yeah, so we kind of felt that our bottom-up was a lot more accurate because we could see the accurate drivers that were pushing their revenue in the forecasted years. The top-down we saw as not as accurate. Our variance was around 50% within the first years. So that's why we didn't use that for any of our evaluations. We mainly just use it as a reference to show how their CapEx spending of their main customers kind of impacted their revenue over time. But due to that high variance, we kind of discounted that and didn't really use it. And we thought our bottom-up was a lot more accurate.
In thesis one, you mentioned that the backlog is really strong, but you also said that the stock's kind of the strong performance in the last couple of months was due to the strong backlog. What do you think is not priced in by the market?
So it seems pretty obvious that you could see this backlog right here that management's forecasting. But where I think the market's missing is with the year that we just had where they only converted 51%, the market is discounting that backlog much more than they probably should, where historically we're seeing them convert over 93% of backlog during normal circumstances. And I would say that this year they were, again, like adding on to Caitlin's question, like definitely not normal circumstances with the legislation and supply changes that they had to make. So that's where I think the disconnect is.
Could you give a little bit more color on the ITC tax credits? Are those like already baked into that 12% hardware margin, or are they not including that? Like when you talk about the opportunity for margin expansion, like do you see the tax credits as like an opportunity for that, or could it be a threat if they are taken away?
So the ITC tax credit applies to their customers. So their customers are going to receive that tax credit, but in return, Fluence would be able to have kind of two things. They would have pricing headroom, so they would allow, they would still be competitive because they have that 10% headroom. And then they would also be able to have competitiveness with their customers choosing that. And the ITC content advantage is based on cells that are manufactured, not necessarily completely sourced or assembled. And that's where a lot of their competitors are seeing that issue. They're assembling all of their stuff in the US, but that ITC content only requires them to manufacture.
Do you think there's a possibility that foreign competitors, say from China, may be subsidized by their government and become like even more competitive on price compared to a US company, even with tax subsidies?
I don't think so, because the new regulations with foreign entity of concern, that's going to be a huge thing that's only going to take effect into 2026. So whenever they're looking at their contracts that are being bid to them, they're not just looking at price, they're looking at how is regulation going to look like in the next 5 to 10 years. And Fluence offers that FEOC safety, whereas a Chinese manufacturer might offer some pricing discount, but Fluence offers more stability.
What's your proposed time horizon on this, and when do you see the individual thesis points playing out?
Yeah, so our proposed is around 2 years, just because of that one-off backlog visibility. We really want to see they're performing within 2 years. As for our model, we have their cash flow being negative upwards of 2 years. So we really want everything to be installed. So we really want to see the fleet size capacity of their digital applications falling out, as well as their services. So we want to see consecutive quarters of their backlog visibility playing out and their order intake growing, as well as their margins expanding. So we believe for a company like this, we really want to see those play out through a couple quarters. So we believe around 2 years is viable horizon.
But for time, I think that's all we can do for questions. Appreciate it. Switch to
Welcome, everyone. We're here to pitch you a long position in Genuine Parts Company. My name is Will.
My name is Nicholas.
My name is Jet. Before we get started, I'd like to thank Sam and Delaney for all their support over the last few weeks. We're going to be going through our company and industry overview, followed by our 3 thesis points, and close our evaluation and final recommendation. The automotive aftermarket runs on a simple flow. Manufacturers produce parts, and large players act as both distributors and retailers, supplying repair shops and directly to the consumer. What makes this industry so strong is that auto repair is non-discretionary. If something breaks, you have to fix it. Right now, the market's in well positioned. Cars on US roads are average around 2013 model, and people are driving more than ever. Older cars mean more wear, more failure points, and more consistent demand for replacement parts. Repair falls into 2 categories: DIY and do it for me. DIY is as it sounds. You fix it yourself. You go to the store, buy a part, fix it yourself. And there's do it for me, which is DIFM. This is where the industry is heading. This is where you go to the store and leave it up to the professional. And right now, the industry is heading that way because cars are increasing in complexity.
Now let's take a look at the industrial aftermarket industry. We have our manufacturers who make industrial parts and then deliver them to our distributors. Our distributors then use their large network of hubs throughout the nation to deliver bearings, hydraulics, and electrical pieces. Now, factories really need these parts, making distributors an extremely critical part of this process. Without them, downtime is extremely costly for factories. Right now, from a macroeconomic standpoint, we have a lot of manufacturers shifting towards North America to reduce those tariff costs. Additionally, you can see that the revenue has been pretty volatile, and this is because a lot of their capital-intensive projects are pretty reliant on the economy and consumer sentiment.
So why are we talking about 2 industries? The reason is because GPC operates 2 main segments: its automotive segment in its industrial segment. The automotive segment operates under the brand Napa and is similar to companies you may know, such as O'Reilly or AutoZone. However, it's structurally different in a couple different ways. First, it's revenue exposure. About 80% of Napa's revenue comes from the do-it-for-me segment, which is where you take your car into a professional, while only 20% comes from the do-it-yourself segment. This is different from competitors who have about a 50-50 split. Furthermore, their store ownership model is different. Competitors such as AutoZone and O'Reilly only operate company-owned stores, where GPC operates both company-owned and independent stores. Independent stores allow GPC to penetrate rural markets where a local owner may have better knowledge. Moving over to their industrial segment, about 80% of revenue comes from maintenance and repair. So this is stable recurring cash flows that come from parts aging and failing and isn't really correlated with cyclical industry metrics. However, about 20% comes from capital intensive projects, which is where someone opens a new factory and needs parts for new machines. This is correlated with macroeconomic factors and industrial sentiment.
Vehicle complexity has increased massively over the last decade. Right now, cars have around 500 chips and advanced software components. The market looks at this as a headwind, assuming that OEMs will lock up parts and push repair back to dealerships. And this is not the case. Independent repair dealership repairs have gone down from 33% in 2018 to 29% today. Also, with new car sales slowing and vehicle prices increasing, they're keeping the same cars on the road for longer. Lastly, with a surge in ADAS penetration, ADAS, which is advanced driver assistance systems, these are the sensors on your car that beep if you're about to crash, and these require more software and complex parts. So right now, they're around 80% of cars have these integrated into their system, and this is a large reason why the industry is shifting towards the do-it-for-me model. And because GPC is so dominant in that sector, in that model, they're going to capture a lot of that market share.
The Genuine Parts Company obviously has these two major segments, Napa and Motion. Now, Napa's revenue is really in line with its peers, but on the flip side, Motion's is not, and it fluctuates quite a bit. Because of this, the lack of performance shown by Motion is really dragging down Napa's multiple. However, like a strong indicator over here, an increase in backlog by 20% over the past year really shows that Motion is starting to perform at a much higher rate. And because of this, we expect an enterprise value to rise close to the implied EV that we have here.
Yeah, diving back into our Napa segment, I want to revisit the independent versus company-owned store models. Company-owned store, while independent stores are important, company-owned stores generate higher margins as you're getting revenue directly from a customer rather than selling parts to the independent owner, and give the company more control over the day-to-day operations of the store. Given this, management has aggressively bought out independent owners in the US, switching from about 20% company-owned stores in 2020 to about 35% of total stores being company-owned today. GPC's independent store model gives them another unique advantage, and that's international presence. Because GPC has this independent store model, they have presence abroad. About 70% of their stores are independent. However, as you can see, that mix has not shifted as it has in the United States. This is because they are new. They've been in the United States for decades and only in Europe for years. As they build their brand in Europe, we think that they will be able to pull what we call the third lever. The two traditional levers for growth are organic growth, selling more parts, and inorganic growth, opening new stores. However, because of their unique store ownership model, GPC can pull a third lever, which is converting independently owned stores to company-owned stores, boosting margins and giving them operational control.
GPC is a seasoned and very experienced leadership team. Current CEO William Stengel stepped in 2024, and former CEO Paul Donahue, after 20 years, stepped down, but he didn't just leave. He stays part of the executive advisory committee, allowing for a seamless leadership transition. Also, GPC stock has moved similarly with the broader market, and any major changes have been due to external geopolitical factors.
It's very important to look at Genuine Parts Company's potential risks. One very notable one revolves around original equipment manufacturers. A lot of people right now are concerned that OEMs are going to start to take market share of cars that need replacement parts or repairs. However, a lot of these cars are actually outside of their OEM warranty period, meaning that demand is actually going to start shifting towards the auto aftermarket industry, companies like GPC.
As I mentioned, GPC has both their automotive and industrial segment, so we compared them to a peer set across both segments. As you can see, they trade much below much of their peers, leading us to the numbers you see on the screen here. Looking at our DCF, we forecast a recovery in the motion business and continued strong performance through their Napa business, leading us to an implied upside of about 18%.
We recommend the Boulevard Investment Group purchase shares at GPC's current price of $130 because of three main thesis points. One being GPC's strong do-it-for-me model is going to capture a large market share with increased vehicle complexity and deferred maintenance.
As motion starts to increase performance, the true value of the company will be unlocked, increase share price.
And finally, we believe that GPC can pull the third lever, especially in Europe, driving growth.
Thank you, and we are now open to any questions.
Some of the parts valuations tend to be pretty hard to unlock. Can you kind of walk me through how you think that actually is going to unlock?
Yeah, so if you look, their Napa segment has been performing in line with peers. And when investors think of GPC, they think of it as an automotive parts company. However, 40% of their revenue comes from their motion segment, which has not been performing well. And remember, 20% of the revenue in that segment comes from these capital intensive projects, which are heavily dependent on economic factors. You know, if people aren't building that many factories because they're worried about tariffs or interest rates are high, they're not really going to be buying quite as many parts. And so that segment is susceptible to that. However, we see tariffs, kind of the uncertainty around tariffs easing. COVID is easing, and general macroeconomic sentiment in the industrial space is projected to increase. We saw 20% growth in backlog year over year. And so we predict that this motion segment is going to start performing better. And once that happens, the value that kind of drags down in their automotive segment should start to be unlocked, and our enterprise value should start approaching that implied enterprise value you see on the screen. Arson?
Oh, yeah. So just talking about the third lever that y'all are able to pull with these independent to company-owned store conversions, can you kind of just walk me through the store economics and how converting stores from independent ownership to company-wide ownership actually increases margins?
Yeah, I can take that one. So management does not explicitly break out revenue per store metrics for company-owned and independent-owned stores, but they do cite in earnings calls that company-owned stores have higher gross margin because you're making revenue, directly from the customer. So an independent store, Napa, under GPC, sells a part to the independent owners. That independent owner then sells the part to the customer and takes a profit off the top. When Napa buys out this independent owner, they get the revenue directly from the customer. So they get that extra little slice of profit kind of off the top. And then another intangible benefit there is that they are able to control the day-to-day operations in the store. So for example, in the past 3 quarters, independent store owners haven't been buying quite as much inventory because they're worried about macroeconomic conditions, want to keep their balance sheets tight, whereas company-owned stores have been because Napa as a company can control all of those day-to-day operational things.
Same topic, what regulatory differences do you see between the US and European market? Are there other things beyond it just being like, a few independently located firms that's stopping GPC from starting to move more towards company?
Biggest one. All right, so in Europe, we're seeing a lot less brand presence from Napa, and what they're doing is they're going in with they're not going in like right away. They're not taking those stores from independent and turning them into Napa stores. They're building them from the inside out. They want to build that brand recognition through their private label, which they're slowly starting to expand in Europe, and that's going to build the brand presence there. And then by doing that, they're going to be able to open up these Napa stores and people are comfortable going to them rather than a store that's been around for a while that people look at as like a mom and pop store. I'm going to go to Jets Auto Parts because he's been there for 20 years.
I recognize that this is more of a distributor than a manufacturer, but recently there's been a lot of distress and bankruptcy in the auto part manufacturer space, with companies like First Brands and Superior Industries. Do you think that distress will come downstream towards your distributors and kind of more retail locations?
I can take that one. The shorter answer is no. So as Jet talked about, buying auto parts to fix your car is a non-discretionary expense. Tariffs, we saw a large increase in kind of the raw materials and raw parts costs. Napa actually saw a 1% gross margin benefit from this because they were able to pass the costs all the way to the customer. So they have pretty strong pricing power. As it regards to First Brands is a large parts manufacturer that recently entered bankruptcy. about 3% of Napa's COGS, our cost of goods sold, are exposed to First Brands. However, they've seen no impact from the bankruptcy. They're still receiving the parts as normal, and said that they have other suppliers lined up. So in case First Brands goes completely under, they will be covered and not see any significant impact.
So kind of as it relates to pricing power, seemingly they've been able to keep their margin profiles pretty healthy. But I know that in the auto tech vertical in general, there's a lot of downward pressure created by insurance companies, because when you get in a crash and then you have to bring your car to the parts procurer, the insurance battles with the procurer to drive down the parts cost. So how does that look on their margins?
I can take that one. Frankly, it's not a huge adverse impact, and we haven't really seen that as a major issue threatening the business. Insurers don't have amazing pricing power because the insured, the car, is kind of a necessary function to survive as a human in the United States. And so we haven't seen, a huge adverse impact of them having a lot of pricing power to kind of reduce revenue for these companies. And then, another interesting point on that is that would be a completely industry-wide headwind and has already been priced in. And so we don't see that as a huge risk to an investment in GPC.
On thesis one, you guys talked about putting off maintenance in 2025 or not optional. I'm wondering where you guys got that. Like, why are they actually putting off repairs? And what do you guys see that will cause them to make these repairs in 2026?
I can take the one. Consumers have drawn back on spending this year, essentially, is kind of the general trend there. And so as a result, a consumer sees their check engine light go on, or they realize that their tire tread is low and their car's not going to instantly crash because of that. And because their consumers are being cautious about their spending, they don't instantly take it in. But eventually that check engine light is going to, break your car, your tire is going to pop because it has low tread. And so the bird kind of comes back to roost at some point. And so we kind of see that as maybe a year, 2 years maximum, that this kind of pullback in this mandatory maintenance spending will kind of reemerge. And so, yeah, hope that answers your question.
But shouldn't there, in 2023, the same thing happen? So aren't the birds going back to roost from 2023? Like, what makes 2025 different?
We didn't see, huge deferred maintenance in 2023. I think we're seeing a stronger trend of that in, 2025. And again, they can defer maintenance for, X amount of time, and that's not an easily quantifiable number, but it's within the 2-3 year time horizon. And so all of this, kind of kicking the can down the road behavior from consumers won't last forever. And so given that we recommend an investment time horizon of, about 2 years, we estimate that sometime within that horizon, this deferred maintenance will, kind of come back.
And where are you guys seeing this deferred maintenance? It looks like industry revenue is continuing to grow as it was through 24.
Yeah. Do you mean where we see this in our models forecasted moving forward?
Yeah.
We forecasted in 2026. And again, there's a lot of uncertainty regarding tariffs and whatnot. This year, that is expected to kind of abate going into 2026. So we're bullish on general sentiment throughout 2026. And so we model slight bump in, Napa revenue in 2026 because of that deferred maintenance.
Thank you.
So you mentioned how the industry is seeing a rise in the number of parts needed to complete these replacement and repairs. And so if GPC is going to actually capture on this, why would you model in inventory days decreasing if they're going to have to carry more parts to actually be able to then distribute them to their stores?
One kind of clarification I'd put there is it's not necessarily that more parts need to go into these repairs. It's that the parts themselves are more complex. So as Jet talked about, the advanced driver assistance systems, those are software components. Like you're drifting out of a lane and your car beeps. That's a software component that if your car gets into a crash and needs to get repaired, that will need to be recalibrated. And so that's not necessarily 10 additional parts that are going into repairing this car. It's just a more complicated step in the repair that the average consumer, can't do themselves. So that's an important clarification I'd make there, and that's fire inventory. It's latest.
On the industrial parts landscape in the industry of revenue, when you kind of talk about the volatile demand, I'm kind of curious what you guys view to be drivers of an inflection point in these capital intensive projects. And let's say that there remains kind of a similar macroeconomic scenario where we're not seeing these capital intensive projects for, in the next 1, 2, 3 years. Is there any way that GPC is really able to mitigate that as compared to other competitors within the industry?
Yeah, I can take this. I mean, a lot of the volatility has really just been around, revolving around these uncertainty with tariffs and things like that. To answer your second part of the question, I feel like with GPC being able to capitalize better, 20% of their revenue comes from that capital intensive projects, which is really reliant on the economy and the macroeconomic conditions. Also, I will say industry-wide PMI is something that's been growing, which is just the index that measures kind of the overall strength and growth of the economy. And so with that on the rise, we can see how that 20% revenue segment is going to make for GPC and industry.
Is there any benefit to Motion and Napa being a combined entity, or should we kind of be looking toward more a pure player? Why should we invest in the two as a whole?
Yeah, so it's a benefit from diversification, right, across different industries. So I don't know, let's say a meteor hits every factory in the United States, you still have the automotive business and vice versa for the industrial business. However, analysts and equity researchers consistently ask management about potentially splitting off this business and kind of unlocking value that way. Management so far has said they will not do that because there's some kind of synergies between, selling parts to cars and selling parts to industrial customers, a little bit of overlap there. But the main benefit of kind of investing in this is that diversification. And then as we see, Motion's expected revenue increase, we think that some of that value in the automotive segment that's been dragged down by that really choppy Motion segment in the past couple of years may be unlocked. And so that's kind of additional upside in investing in GPC versus a competitor like O'Reilly or AutoZone.
So you guys previously mentioned that like in Q2 and Q3 of 2024 that GPC has acquired like 184 companies. And because of that, do you have any like statistic on like GPC's like profit margin when it's acquiring those independent Napa stores and turning into company-owned one?
Yeah, so you'll see a little bit of gross margin benefit because, as I mentioned, you get that sell-through benefit from getting revenue directly from the customer. In the near term, however, SG&A costs have historically been pretty high, and part of that is due to not integration challenges, but just integrating these businesses. And so we kind of have to give and take. However, moving forward, management guides for that SG&A wage inflation to kind of reduce a little bit. And so in the long term, we're going to see a slight gross margin benefit from that, which will trickle down to the bottom line.
Yeah, we need to move. Thank you so much.
Hello, everyone. I want to first start us off by giving thanks to Brock and Owen for all the help they've given us throughout this pitch so far. Without further ado, I'm Chuck Palmer.
I'm Katie Yao.
And I'm Gabe Pringle. We're going to be presenting today on why we believe the Boulevard Investment Group should purchase shares of Digital Bridge. Picture above us is our agenda slide. Here are the main line items that we're going to be talking about in the pitch today. I'm going to pass it off to Katie Yao to start with our industry overview.
So Digital Bridge is an asset manager in the digital infrastructure market. In this market, exponential demand for training and computes have created cascades along a technology stack. At the top of this stack resides the AI applications, and at the bottom is the infrastructure. As the upper layers grow, it creates a new wave of growth at the bottom foundational phase where Digital Bridge is residing. Now, with structural shifts, Digital Bridge is positioned to capture a lot of the hybridization as companies are moving to combine cloud data centers with traditional enterprise facilities. And so a lot of these assets are captured with the trends with the Vantage and the data banks. So Digital Bridge has 3 flagship funds, DBP 1 through 3. These funds pool investor capital so that DigitalBridge can go out, acquire, and manage a lot of digital assets like data centers and towers. Just recently, they announced the closing of their third fund at $11.7 billion in investor commitments. Now, capital is sourced from institutional LPs, private wealth, family offices, and their own co-investments. Fee earning equity, which is the portion of their assets that generate recurring fee revenue, has grown steadily in the past few years. And as their DBP funds expand, so do their total assets under management.
DigitalBridge is invested across every major layer of digital infrastructure. So that's edge, data centers, towers, and fiber, which provides them with massive scale advantages, as well as the ability to position their capital wherever they see demand accelerating. So essentially, by being invested across the entire stack, DigitalBridge is able to identify growth trends earlier and then position their capital ahead of their peers in single vertical and generalist funds.
Yeah, when talking about the company as a whole, it's really important to note their transition from their legacy REIT model to their now new asset management-based model. To give a little background on this, what I essentially mean is they used to be a real estate investment trust. What this means is that they would own these assets that their funds currently own. However, the problem with this is they face the massive operating and management expenses with actually owning these data centers, fiber optics, and other edge utilities as well. Now with their new model, such as a fee-based manager, such as other traditional private equity managers, such as think of your Blackstone or your Apollo, they earn revenue from these three main sources of their management fees, carried interest, and co-investment. This essentially creates these stable fee-related earnings as they're actually owning funds that then own companies that have these assets, so they're removed from that primary risk of owning the data centers themselves. Pictured here is our stock performance slide. This essentially overlays DigitalBridge return compared with a major digital realty ETF and the S&P 500.
So DigitalBridge is unique because it is the only pure play that gives public investors access to private market digital infrastructure platforms. Unlike traditional REITs, they have more flexibility in their structure, and their assets are more well-positioned to meet demand. So specifically with 5G and urbanization, they've called for reliance on really good fiber networks because of all of the surges in data traffic. In addition, with AI inference, they've been done using edge data centers, creating this massive need for latency concerns. As such, a lot of this dynamic is being reinforced by each other, and DigitalBridge's portfolio captures both sides of this equation, further translating into steady capital growth from investors who also see these secular tailwinds.
Moving on to our second thesis point, I'm going to talk a little bit about their efficient fundraising cycle and how it causes fee equity earnings, asset under management growth. To give a little background with their fundraising cycle, to talk a little bit about their FEEUM expansion, it's important to note their LP reinvestment. What I essentially mean by this is when DigitalBridge opens up a fund and they have their LPs now invest in this fund, they're now to open up a second or a third fund. You see typically very high rollover between these LPs reinvesting capital due to the returns in their asset quality. This creates very high visibility, stable fundraising that due to their business structure, they're able to quickly deploy into their assets under management. This creates the self-reinforcing cycle where due to their assets, they're able to create this fundraising, their LPs roll these funds into new funds, and these funds buy this fee earning equity under management. And with this equity under management is where they actually earn their fee related earnings, which creates that stable revenue stream.
Public investors have historically struggled to underwrite DigitalBridge's true earnings power because of its volatile nature under GAAP accounting. Therefore, the market overlooks how steady fee earnings growth is the true driver of value for these asset managers. So while the stock has lagged, AUM has soared with, like we mentioned earlier, the closing of their third fund at record highs. Therefore, we see that an opportunity for, therefore we see that as LPs recognize the value within DigitalBridge's platform, the public investors have overly punished DigitalBridge throughout their transition. This presents an opportunity for the stock to be repriced as their asset base that provides them with their fee earnings continues to mature. Additionally, the optionality aspect of their business model is wildly overlooked. DigitalBridge owns 100% of their GP stakes, which means that they can provide investors with upside through future monetization events.
So there are risks involving hyperscaler demand in the technology market, as disagreements over AI and compute contribute to volatility. However, DigitalBridge is positioned at the foundational infrastructure layer that digital workloads are being relied on instead of the workloads themselves. And so their revenue is insulated from the volatility in the application layer.
For a comp set, we used a set of generalist fee-driven asset managers, while mainly because DigitalBridge is the only pure play, fully digital infrastructure focused asset manager on the market. As for our DCF, we arrived at an attractive valuation driven by expansion within our fee earners.
Sum it all up, we recommend that the Boulevard Investment Group purchase shares of DigitalBridge at its current price for three key reasons. One being the public door provides into a private market with their digital infrastructure fee management based fund. Second being their efficient fundraising cycle that allows them to deploy this through their business structure into new equity earnings under management to create their fee revenue earnings. And third being the legacy baggage they still carry from their REIT model that's being factored in their valuation without the full realization of their optionality and their growing fee related earnings. Thank you all for listening. We're happy to take any questions from the audience. Go ahead, Jonah.
You guys spent a little bit more time justifying like using comparable companies as something you weighed the valuation at all. And also talking about, it seems like fee related earnings makes sense, but then like the comps that you chose, like their fee related earnings like 5 to 10% of each of these comps depending on the business. So each of those would be helpful.
Yeah, so with kind of the logic behind our comp set, it's pretty difficult to find exact comps due to the sector and market they play in. As we mentioned, it's kind of the only, pure play digital infrastructure company into that private market. But the commonality between these companies and these asset managers, they're typically valued, by their fee related earnings, as that's usually a chunk of their revenue stream. So we picked asset managers that had kind of that high fee related earnings as well for valuing our comps. And that's why we weighted it a little bit less, because we didn't have that exact sector match.
And one other thing on like the fee related earnings, a lot of times, we're thinking about comparable companies, like we want to look at a forward looking multiple metric. How do you think about fee related earnings maybe being a better representation of like the unit economics of DigitalBridge, but like comparing that to getting to use like EV/EBITDA and using like a next 12-month version?
Right. So it was kind of difficult with the next 12-month EV fee related earnings, kind of projecting that, for DigitalBridge itself, and then also its comps. Ran into some, management guidance issues with that as well. So we want to look at over their last 12 months with the stock price that DigitalBridge was at for, that reported, last 4-quarter EV fee related earnings, which is kind of why we went with that over, an EV/EBITDA metric, because like I said, EV fee related or just fee related earnings in general is kind of the most important metric for evaluating an asset manager. Go ahead, Rylan.
Okay, diving a little bit more on this whole like asset manager thing. Like I get it that they derive money from like LPPs, but like how are they deploying capital? Like is this a private credit type thing? Are they taking equity stakes in some of these assets? Are they taking a mix? Like what's their underlying portfolio look like?
So their main capital sources, so they have a separate DBP funds, so 1, 2, and 3. And so this capital is sourced from these institutional LPs. They have a credit arm, but this doesn't really contribute too much to revenue, as this credit arm is simply just for providing investments for assets that they don't manage. And as for the funds, they do provide some of their co-investments, but according to the total assets under management, there's only a certain section of that is being contributed to their fee earning equity, which is the ones that they generate their actual revenue off of and are fee related earnings.
Okay, I get who's giving them the capital to manage, but like how are they actually deploying that capital? Like where they sit on the cap stack on like their typical investment. Like essentially what I'm trying to ask is for all this like data center stuff, are they underwriting the equity portion of some of these investments? Are they underwriting like super senior debt? Like kind of where is that money falling?
So I believe the main target when they are going through these investments is simply just injecting equity into them. And then as well, like having that operations team being able to kind of advise on the continued growth of those assets as well. So to answer that is purely like equity injection.
Yeah, Caitlin.
AI infrastructure has obviously been kind of a hot button topic for the last couple months. Do you guys worry at all about valuations increasing too much and DigitalBridge starting to overpay for some of these assets as they start to deploy their most recent fund?
No, we don't believe so. A good example I can take on is AMD, which stock has recently fell after Meta announced that they're going to start buying TPUs from Alphabet. And AMD is a good example because they also have this really good advantage when it comes to co-location. So having both an advantage in inference, but also regular data centers. And so a lot of the infrastructure that we've been projecting about Digital Bridge is about how these data centers are able to capture hybridization. And with the urbanization, there's these fiber networks that need faster transmission times. And so edge data centers in particular are able to provide this because of how close they are to their real-time users. And so investors, there's a really big disconnect between what they understand about the tech market and what is actually going on. And especially with the current discount that Digital Bridge is at, it just really shows that the investors aren't really seeing them as this pure play digital asset manager. And so we don't think that a lot of their infrastructure assets are going to start being overvalued.
To add to that, one of the benefits of being invested across the full stack is that as management sites, they're able to receive the most attractive valuations from these companies because they have this wide breadth of knowledge because of how widespread they are in the industry. And so these companies that they're investing in are recognizing that and then, really valuing that when it comes to their entry valuation.
The market realized that they shouldn't trade like a REIT, but an asset manager.
Yeah, so presently they've already fully divested from all of their REIT type operations, and so presently investors are still really looking at the high volatility within their overall revenue, which masks that fee revenue underlying growth. And so, really, what public investors are worried about or asking a lot of questions during earnings is that carried interest. And so that is historically what has really driven that volatility there. And so as we're able to see that aligned with management's guidance as it becoming fully net positive between 26 and 27, we're going to see the investor sentiment flip in that regard.
I'd also like to add on that recently, with the talks of SoftBank, the Japanese multinational corporation that is interested in digital infrastructure, there's been talks about them wanting to acquire Digital Bridge. And so I think this really puts a spotlight on them that they are this really good pure play digital asset platform. And I also think with or without this acquisition actually going through, it's really going to make the investors believe that there's this transition that they're really not recognizing.
Go ahead, Kate.
Why does Digital Bridge deserve to trade median to Q3?
Yeah, kind of with their median to Q3 growth is, obviously comparing them to, their comp set of, Apollo, Blue Owl, or Brookfield. Obviously, these asset managers are a lot larger of companies. So we kind of see a lot of growth, especially with their fee-related earnings projections as, more of a growth play compared to these larger, blue chip asset managers, which is why we had kind of a higher growth median to Q3 projection. Go aside.
You guys did a good job putting this together, especially over what happened over the weekend. And it's been a tough nut to crack, but I think a few pages ago you had a list of their different assets, if they're different portfolio companies. A big part of the growth story here is which ones they're going to monetize and which ones they're going to carry over as you're in your forecast. So which one of these assets do you think they're going to monetize in the near future? Which ones do you think are going to accrue carry? Because ultimately, that's what's driving the FRE.
Yeah, so I can answer the first part of that question. A lot of the assets that I think we're going to monetize is just the data centers because they're very capital intensive, but they do generate very steady cash flows. In 2023, they actually did a recapitalization of DataBank, one of their digital infrastructure assets that are about data centers. And from that, they lowered their stake, but also got around 200 million in commitments from that. And so it's just a good way to do these partial exits and another recapitalization while still getting back this capital and maintaining exposure in that field. And so I think a lot of the hyperscaling data centers are just good assets to monetize.
From because this is a pitch for Digital Bridge's corporate equity, how much of that equity is getting staked as a GP stake when they go and do these funds? Effectively, how much is, if we were to invest in how much of our capital is at risk in the underlying investments, which seem to just be really concentrated AI data center telecom plays?
Yeah, kind of going into that with their co-invested capital versus their DBP series or their LP stakes. You can kind of see a little bit with their year-to-date fundraising on that. bar on the left side there, you can see like what part kind of split from their credit, their co-invested capital in from their fund series as well. Kind of seeing that equal split essentially, but at the same time, we see some expansion with their co-invested capital as that's kind of part of their principal investment income revenue stream due to the fact that when they invest in their own funds out of their own balance sheet assets, you see kind of that growth or that return on their invested capital.
Do they disclose their performance for their LP investors? Like how would they return to their investors so far?
The main metric we have to recognize performance of their investments is through the carried interest. However, the entire line item is based on a preferred hurdle that these investments have. And so fluctuations of 1% or over or under that exact hurdle can have vast implications on the actual line item that's reported. And so the overall accuracy of the fund's performance that we're able to see doesn't really recognize how those assets are actually performing, especially as they are super early stage overall and continue to mature.
But there's no estimate. It has to be good if they're raising $3 billion and then all of a sudden they go to $11 billion fund.
Right, exactly.
And then did you analyze this company from if the market dries up and they don't raise any more money going forward, what the valuation would be? Like if they can't raise a fourth fund or liquidation valuation with their other businesses?
I guess kind of looking at that, you'd have to look at when their current funds are going to mature. Looking at, I guess, for example, what happened over the weekend with kind of the talks of their, data center funds being bought out. I guess the way to kind of forecast or project that if they're not able to raise funds anymore, whether from, LPs not willing to, invest capital, they stop co-investing their balance sheet capital. You just have to look at, when the funds they currently have are going to currently mature, and I guess kind of estimate and value what they, sell for or be rumored to sell for. Go aside.
I guess adding to Ronald's question, and if I go over, please cut me off. But earlier I asked monetizing and then accruing carry, those are two different things, right? Mm-hmm. So when you have asset monetization, you mentioned data centers, but those are the same assets that are supposed to accrue carry over time. So I guess going back to that question, which of their assets are going to accrue carry and which ones are going to be monetized? If you're saying that the data center assets are really that are really in a hot streak, then you're probably not going to monetize those. You're probably going to let those accrue carry. So which one of those two kind of is it? A ton of different ones in the portfolio as well.
Well, I would say one of the most recent exits that they've made is Digita, one of their tower companies. And they were able to raise the tower sites in Digita from around 200 to 950 sites. And it just goes to show that they're a really good asset manager. So when it comes to exits, I would assume that they'd base it off of maturity. So Digita came from their very first fund, DBP1, and so it was able to reach a really good maturity and had that really good exit. And so when it comes to being able to monetize assets to accrue carry, it just goes to show which fund that they are in and how well they were able to raise it.
How many active funds do they have across the portfolio right now, and what's the vintage of the earliest fund? And any performance data that they have against that in terms of DPI or TVPI as far as the earlier vintage funds are concerned?
So they currently have 3 funds: DBP1, DBP2, and DBP3. DBP1 closed and started kind of during their whole transition stage. So it started in around 2019 and it closed in pretty early after their transition. I want to say 2022. And right now they just closed their 3rd fund.
And what's the expected hold period on those funds? The 7-year hold or something?
Yeah, it's around 7 or so years when they decide they want to exit the assets inside the fund.
Perfect. Thank you so much. We're going to do a quick break. We'll start again around 7:45, maybe 7:47. 5 or 10 minutes. I'll stand up. Walk around.
You literally should have put it down.
We pitched on Noble. Noble. We bought it.
They saw the big.
Yeah, we probably knew it better.
Okay, yes.
Oh, yeah, well, good check. Yeah. It's only the JAC. Yeah. Like he's. Yeah. Yeah. What's the end of the year? No, like. I hate energy. No, yeah. Well, no, that's it. It still hasn't come yet. No. Like, yeah, it's like somebody in third grade is asking you a question. Like, so actually 5 minutes ago, there's an article you should have read, and so what I'm talking about. I should have known that. Oh my gosh, I've heard worse stories. He wasn't doing that. Okay, so I literally.
All right. Well.
It'll change a lot once. Now I correct my name. Mechanical keyboard in the back. Really sorry, I got a lot of work to do. It's a little bigger than that. Like honestly, I realize it's not even about like are you in Banya? Where's your hair? Oh yeah. Go back. Second time. I was actually like planning on it, and then they 10 years ago. It's making me regret my choice. It's like when you get did you buy it? It's got big, I'm not a change. You here? Yeah. I want to see how they're. I want to see how you want to say how we go here? Good. Thank you. Yeah. So I was in your shoes. Yeah. It was like
We're really excited to pitch you along today on Arista Networks. My name is Lucas Saga.
I'm Brody Carlton. My name's Taylor Scout.
We want to give a special thanks to both Tanner and Jack for their help along the way. That being said, here's our agenda for the evening. Brody, to get us started.
Networking infrastructure industry is defined by the sale of hardware and software to hyperscalers, enterprises, and service providers. Hardware is your physical infrastructure, and software is like your operating system. Looking at some industry trends, Companies like Arista, Cisco, and HPE have to adapt to their customers' needs, which are rapidly evolving. They're steadily increasing their need for AI, cloud computing, and energy efficiency. Additionally, there's an industry-wide shift into Ethernet away from the traditional InfiniBand, which is owned by NVIDIA. This gives a better opportunity for a company like Arista, which will heavily benefit from an open ecosystem being preferred.
Now, you still may be asking yourselves, what is it that Arista sells? And what they sell primarily is primarily split into two offerings: their hardware offerings and their software offerings. When it comes to hardware, they have a few main products that build this offering, and that being their switches, their routers, and something called interconnects and optics. What this is think of sort of cable. And together, all of their hardware offerings come together to serve this purpose of getting data from point A to point B. Now, you may ask, why would someone go with Arista for these hardware offerings? It's because they're incredibly specialized at doing one thing specifically, and that is getting data from point A to point B in a very efficient manner that doesn't waste it with all these other fluff that some of their competitors may have. Now, when it comes to the software offerings, they have two main things, that being EOS, Enterprise Operating System, and CloudVision. Enterprise Operating System is widely recognized as being the best in game when it comes to operating systems for networking infrastructure. And this comes down to its Linux base, which gives it a very open source feel, which allows the customer to do what they need and to really optimize it for the purpose of the specific networks that it operates in. I think CloudVision is a little bit of an add-on for EOS, which allows the overall management of the network to be incredibly easy for the consumer.
Just as Caleb touched on, a majority of their revenue comes from the hardware segment. However, that's not to discount the software segment, which is comprised of their CloudVision subscriptions, which is a growing part of the business as it's tied to the hardware sales. In the past 12 months, Arista has taken substantial share gains in the highest performing parts of the industry. That's data center switching, that's GPU compute clusters, and both 400 gigabyte and 800 gigabyte switching, all made possible by their core customers of hyperscalers, enterprises, and finally service providers. They also have a long tenured management team and have outperformed the S&P 500 over the past 12 months.
Now let's get into the heart of our differentiated view. This primarily stems from these industry changes in HPC and hyperscaler. What's going on here is there's this across the board scaling of these facilities where they're getting much larger. And in this, there's this trend on the emerging end of the scaling where the total bandwidth required for these facilities is growing at a pace that is outpacing the rate at which the compute in these facilities is growing. This creates this sort of super linear correlation between the two, where the total network bandwidth for these facilities is growing at this increasing rate. And now you may ask, how does this apply to Arista's revenue? And what this is the total network bandwidth for these facilities is a direct corollary to the amount of CapEx that all of the facilities, HPCs, and hyperscalers are having to spend on networking technologies. And this then directly funnels into Arista's revenue streams.
While the rest of the industry is fighting to keep up with this increase in bandwidth, Arista has fully aligned its product strategy to the pace of compute. By standardizing on something called merchant silicon, Arista is tapping into Broadcom's multi-billion-dollar ASIC. What this means is that it's negating the hefty R&D and the long production timeline associated with customized silicon. What gives this power is it's their unique operating system. EOS is one unified operating system that allows them to deploy across hundreds of thousands of switches like that. That is why hyperscalers are switching towards Arista as the default for both 800 gigabyte switching and upcoming 1.6 terabyte switching, which we expect them to benefit from tremendously. They operate in the hardware space at the speed of merchant silicon and the software at that cloud provider. So Arista will benefit greatly in the next generation higher bandwidth markets because they are bypassing the customization bottlenecks, and EOS allows them to scale at speed, ultimately creating a first to market advantage that is underappreciated and cannot be replicated.
Now, hyperscalers can only scale up or add on to their additional data centers for so long. Problems with energy, power grid, and cost efficiency arise.
So where does the industry grow from here? The answer is in scaling across. This is the idea that hyperscalers are interconnecting their data centers to act as one unit. This increases GPU utilization rates and overall workload distribution efficiency. Now, why hasn't this been able to be done before? Well, today's networking technology has not provided the reach and speed that is required to make scaling across a feasible option. However, with new chip development and Arista's early development, they are projected to release a product in Q1 of next year that will make scaling across a valuable option. This product is projected to release almost 3 quarters before competitors' similar products, which gives them 3 quarters of uncontested market dominance on an emerging trend. Now, this is very beneficial for Arista, but there's also a huge hidden upside that comes with this. I talked about this idea of GPU utilization rates earlier. And this is the idea that when scaling across, more GPUs are going to be used more frequently. This increases traffic between switches and GPUs and overall leads to a higher bandwidth need. And as Lucas just touched on, there's no better company to capitalize on this higher bandwidth need than Arista. Now, there are a few concerns that investors often have when considering a long position for Arista. The main one of these, and the one that we're going to touch on now, is the fact that Arista trades at rather high trading multiples. However, when you look at the fact that this is a high growth tech company, you realize that these multiples are actually rather justified. And when you create a ratio where you factor in the growth rates and compare them to the multiples, you realize that Arista is not trading at some crazy premium compared to other high growth tech companies. Now, when it comes to the comparable companies, we want to touch on these real briefly because they have a very strong comparable companies list of companies that have very similar offerings and operations, although they might not have quite the same specialties when it comes to specifics to their switches. Now, when we look at the intrinsic valuation of Arista, there are 3 points we want to look at, and that being a revenue exit and an EBITDA exit, and then a Gordon growth. We've chosen not to weight our Gordon growth in our final valuation because Gordon growth is inherently not as reflective of a high growth company such as Arista. To retouch on our theses, facility bandwidth correlation, merchant silicon advantage, and scaling across positioning are all reasons why we believe Boulevard Investment Group should invest in Arista. As you can see, our football field valuation is on to the right. And we're happy to take any questions.
It seems like the main industry tailwind for each of these theses to like really play out the way you want them to be is like AI, data structure, network, like just general CapEx upcycle. If that's the case, like, you know, when you guys are on the like management fit slide where it's got, you know, the performance of each stock over time, like why don't we just invest in the benchmark that you guys put it to, XLK, where we get a lot of that general exposure and it looks like basically the same returns.
Yeah, so I can take that one. So this primarily comes down to the inherent part of where AMET is specifically investing in the bandwidth requirements in these facilities. And it grows into that super linear correlation that we built to in thesis 1 and explaining how with emerging trends in the industry, we can see that bandwidth is becoming an increasingly more important piece of this pie. And by investing specifically in AMET, where you're getting more direct exposure to the bandwidth, you're going to see increased returns regarding that.
On your comparable companies slide, you talked about how Arista's multiples justified due to the growth. But could you touch more like Ciena? What is Ciena? It seems like it has the growth, but it's not trading where
for sure
you think it should. Yeah,
I can take that. So Ciena and Ubiquiti are both high growth, high revenue growth companies. Ciena has a high focus in networking, one of the sectors we talk about, and Ubiquiti had a strong one in enterprise. So they are not as involved in the very high growth sector of AI and cloud, which is why their revenue growth is not as high as. Additionally, we would like to add that both of these, specifically Ciena, has what's considered to be a slightly more inferior product for the specific use cases that are taking off at such high revenue growth rates, which very much builds into thesis 2 specifically.
Can you walk me through like $1 of revenue into this business, both on like how they actually generate that revenue and then how it kind of flows through the COGS and other costs associated? Like, does the revenue come from like bidding contracts from data center construction companies? Is it direct procurement with hyperscalers? Like, kind of how does that work?
Right. So a majority of it comes from hyperscalers. They contract with hyperscalers and they settle on a price in which they're buying X amount of switches. These switches are then contracted with their operating systems, which they can add CloudVision on top of if they would like, which is an additional fee on top of that the EOS system. And that is contracted across a period. That may be a year, that may be a few months. And then that flows into future contracting and like we built out across their main customers. That's customers like Meta, like Microsoft, and then built into customers and a lot of the other larger hyperscalers.
So the dollar itself is coming from not like construction procurement company, but straight from the hyperscaler.
For the most part, the contracting is coming from hyperscalers, their customers.
Okay, and then on that, like in terms of that contract, if say Microsoft or Meta was planning to build a data center and they contracted the procurement of the switches, and then 6 months down the line they decide they don't want to build the data center anymore, like is there still a contractual obligation for them to pay for the switches? Like, are you still recouping revenue there, or is that essentially lost?
Right. So what's unique about Arista is what we touched on earlier, that like first to market. So if it was a 6-month window, they'd be able to get that switch or whatever it may be to them within that window. The one thing we touched on a lot is like that first to market, that day one exposure. So being able to send those switches out upon demand. So if something like that were to happen, yes, it's contractually obligated. However, Arista is uniquely positioned because they're able to get it out so efficiently and in a timely manner as well.
Can you help me wrap my head around the buyer math of, okay, Sienna has a marginally inferior product. How do I, as a buyer, think through, okay, I'm going to use Sienna because it's cheaper versus Arista because it's a better product? How do buyers think about that?
Yeah, so one of the main kind of differentiators as well is Arista operates in higher bandwidth. So it's unique because as the switching becomes more dependent on these higher bandwidths, that's Arista's uniquely specified or specialized within these 800 gigabyte, 1.6 terabyte versus somewhere like Sienna, where if you need like a 100 gigabyte, 200 gigabyte, even up to a 400 gigabyte, they might like that's someone you might want to go to. But as we move towards higher bandwidth, as compute becomes more demanding, Arista is the primary offering for lens.
Also, higher bandwidth is also not required, like necessarily required in the industries or not industry sectors that Sienna and Meta Ubiquity work in. It's very much a big part of AI.
So is there a point at which the incremental upside of the cost of developing the product where the incremental, however many gigabytes is not actually that more valuable? Like, is there a lifespan in which Arista's node kind of dies off, or how does that work?
Well, there's these things called refresh cycles, and that's when you work through, and it's the development. I think Caleb touched on it a little earlier. The development and through different bandwidths, and over time, historically, it's about approximately 2 years where a higher bandwidth starts to become viable. And we're seeing that now from the switch to 800 gigabyte to eventually 1.6 terabyte, a doubling in that switching power, usually used by customers like hyperscalers that require a lot of compute and a lot of bandwidth.
Awesome. Thank you so much.
All right. Hello, everyone. My name is Kira Caffrey.
I'm Vincent Reyes.
And I'm Zach Seiler, and we are here today to pitch you along on Edwards Life Sciences. I'd like to thank everyone for being here, and let's get into it.
So for our agenda, we're going to start with our industry and then company overview slides, then get into our points of differentiation, our valuation, and then we'll wrap up with the final Q&A of tonight.
Before we understand what Edwards does, we really need to understand what valvular heart disease is. Valvular heart disease is essentially diseased tissue that is not able to close or seal properly in the valve, resulting in irregular blood flow across the valve, resulting in increased stress on the heart, and that leads to several key problems for patients, such as fatigue, shortness of breath, and eventual heart failure. Now, when patients are suffering from valvular heart disease, they are faced with two main ways that they can solve this. One, traditional surgery, which is open heart surgery. It's faced with longer procedure times, high cost, and it's quite frankly, higher mortality rate. Now, transcatheter valve replacements procedures and valve therapies have really blown up in the last several years. And this is because they are minimally invasive. Patients are able to go home at the same time or the day after, and it results in a lot lower cost for both providers and patients.
Despite the high mortality rate and the severe nature of valvular heart disease, its demographics are defined by two main trends. One, overwhelming demand, yet severe undertreatment. Aging demographics play a significant role in disease prevalence, and currently the medical field is setting its sights on expanding current treatment applications. This is being done through two initiatives. First, using existing treatments and applying them to different valvular heart diseases. And secondly, using those treatments and applying them to earlier progressions of the disease, both which hold the ultimate goal of improving patient outcomes.
Now let's look into Edwards' role in this current landscape. Historically, the bread and butter of Edwards' sales has been in its transcatheter aortic valve replacements, which we'll be referring to throughout the presentation as TAVR, which is a treatment for aortic stenosis. However, recently they have also delved into a new segment, which is TNTT, which is solutions through valve replacement and repairs for mitral and tricuspid regurgitation. Looking into the future, they have several trials underway because of their aggressive R&D strategy, which explore the current markets they're exposed to, as well as new addressable markets, such as an aortic regurgitation, which is currently untapped. How their sales work is group purchasing organizations and hospitals will purchase their products, and currently there are over 500 hospitals that are trained to use them, and then they are reimbursed by insurance of some sort. And over 1 million patients have been treated by Edwards so far. Then going into our stock performance, Edwards has underperformed some of our key benchmarks, such as the U.S. Medical Device ETF, as well as the S&P 500, despite recent earnings strengths, as well as consistent successful trial data.
Moving into our first thesis, we see that the market is overreacting to current headwinds, which is resulting in a mispricing opportunity. Edwards' current recent underperformance in TAVR sales has been attributed to hospital bottlenecks. This has resulted in a street downgrade of their TAVR year-over-year growth outlook, additionally constraining their valuation multiples. However, hospitals and institutions are instating programs currently which are working to resolve these bottlenecks, and that is being reflected in Edwards' reporting of their year-over-year growth, showing resilience in Q2 of 2025 and Q3 of 25. Despite this, the market has not rewarded Edwards with a re-expansion of their multiples. This can be attributed to an underlying fear of market share erosion resulting from near-term product sentiment. However, this fear underscores the true complexity that's associated with product switching in the medical device field. Edwards stands to gain from an advantage of first mover advantage because of their advantageous relationship with physicians and physician training programs, allowing them to maintain their strong market share. To put it simply, the market is currently not pricing in an acceleration of TAVR growth despite strong economic tailwinds, and we reflect our differentiated view and our revenue growth.
Now shifting from new markets to their operational advantage, as we view that the market is underappreciating the future momentum of their R&D backlog. Recently, huge medtech conglomerates such as Medtronic and Abbott have announced new efforts to enter the cardiovascular medtech space with successful trial data being announced. And thus, investors are skeptical of Edwards' ability to maintain their market share and market share growth over time because of these new trial threats. However, we recognize that since Edwards has sold off their critical care, or since Edwards divested in critical care in 2024, they are now the only pure player company in the cardiovascular medtech industry. And they have deployed all their resources to an R&D strategy that beats other companies, as their trial backlog is still 3 times the size of their closest competitor. And historically, as new trial data is released, such as product releases and positive outcomes, the market reacts and rewards these results with new share price gains. Thus, in the future, we view that their R&D backlog has a lot of momentum potential that investors aren't seeing. And as these new results are released, the share price will continue seeing gains and rewards will continue being seen.
As we take a look at their tricuspid and mitral valve therapies, Edwards' Pascal has demonstrated clear clinical superiority over the leading market share at the moment, which is MitraClip from Abbott. With over a 10% reduction in mitral valve in mitral regurgitation over Abbott's edge-to-edge repair system, this demonstrates that Edwards is able to help patients more effectively than the other industry competitor. Now, this also factors in a lot of cost efficiencies with the therapy itself. The way hospital reimbursement works is hospitals and healthcare providers are reimbursed a flat rate regardless of how number of devices used, the duration of the procedure, or what type of device is used. So if patients are able to have a higher rate of success with Edwards's Pascal system instead of Abbott's MitraClip, this means that over the long run, over thousands of procedures, patients or hospital providers are going to be able to reduce their costs if they use a lower number of devices per procedure. Now, additionally, we see the increase in aging population and the number of patients who are able to receive the edge-to-edge repair therapy increasing over the long run. And because of the low market penetration that we've seen so far, this means that there is adequate growth for Edwards to capture more market share moving forward. Speaking over onto the tricuspid market, Edwards was the first to bring to market a complete mitral tricuspid valve repair system. Now, this differentiates itself from Abbott's approach to the market, where it is an edge-to-edge repair, much like its MitraClip system. However, this has increased its ability to effectively help patients with strong clinical results, and this is warranting of its price premium over Abbott's TriClip system. Now, much like the MitraClip patient base, we see that the aging population and the increase in number of patients who are able to receive this treatment increasing over time allows adequate market share or adequate growth over the next several years.
And going into our comps, we selected our comps based off of other companies that are pure players in their respective industries. And then to the left, we also have like our product competitors. So these are our competitors that are direct have products that directly compete with us. However, just because of the scope of the companies, other spaces they have exposure to, they weren't comps for us.
Moving into our discounted cash flow analysis, we chose to look at exclusively our EBITDA exit multiple due to the nature of the scope of the medical device industry. And using our WACC of 7.2% and exit multiple of 25.9, we achieved our approximate upside of approximately 30%.
We suggest that Boulevard Investment Group takes a long position in Edwards Lifesciences at its current price per share, projecting a value growth of $91 per share to $115 per share due to a strong macroeconomic environment playing into acceleration of TAVR sales, undeniable, a premier pipeline of R&D compounded by status as a sole structural heart care provider, and an undeniable clinical superiority in emerging technologies of TMT, leading to a great growth value for this company. Thank you all for your time, and I would love to answer any of your questions.
Have there been any GLP-1 headwind here where like that drug makes the adverse cardiovascular problems less likely just in the general population?
I can speak to this. So a lot of the cardiovascular issues that we see in patients that need this therapy, a lot of it is hereditary. So yes, a lot of it is diet-based and lifestyle-based, but this is not necessarily an issue that we see being necessarily affected by GLP-1 use. Right?
I'm going to add on to that just slightly. A lot of the target market for the transcatheter solutions actually occurs in the Asian population as well, just because of a durability nature. While technology has improved, they are not currently targeting anyone really below 60 years of age. So that drug is not a necessary headwind for us.
Across your comp set, you've got a lot of forecasted multiple compression in the next 12 months. So just curious about those drivers and what.
Yeah, definitely. So our comp set, are you just speaking on the product competitors?
Just in your comps in your model, it's like the median's going to be compressed from 45 turns down to 26.
Mm-hmm. Yeah, definitely. So part of that is going to be kind of headwinds that the med tech industry is facing across the board. We're currently experiencing, as if you were to go back to the stock performance, it's kind of trading in a straight line right now, and the med tech is not performing to its kind of previous growth standards. With that being said, our comparable companies analysis wasn't a direct kind of valuation, particularly because it's very hard to kind of pinpoint a company that has the same kind of growth value as Edwards as a result of them being a pure player that's also very established in their kind of sub-vertical in medtech.
So why would you guys weight this at 30% then when there's clearly a lot of frothiness in the multiples?
Yeah.
I think there is still a lot of significant overlap. I mean, Abbott is a direct competitor in a lot of their markets. That being said, obviously they are a conglomerate. They do oversee a lot of different operations, but it's still significant. I mean, there's a significant portion of Abbott's revenue as well as Medtronic and Boston Scientific that it is important to still kind of compare it against them, as well as kind of the rest of the comp set. But it comes to the point where it's really in a world of its own as far as a pure play structural valve therapy company, and in that aspect, in that regard, it is kind of necessary. It is warranted of have those specific comps.
And with that being said, that's why we kind of included it in our valuation, is because we do put an emphasis on the fact that they are a pure player to this sub-vertical. And so we wanted that to be reflected in our valuation of the company and it not just to be our TCO.
Yeah, what market signals do you think that Edwards is sending to the public with the Medtronic's acquisition, and why was the reaction to it so poor?
Yeah, I mean, I think a lot of it was that after this, its margins were kind of deteriorated a little bit just because they were deploying to a lot of segments at once. So this is around the time that they started heavily investing in their TMTT, and obviously made that acquisition. So their margins were suppressed for a long time, and that was just obviously kind of a negative signal towards their ability to maintain share, a negative signal towards that. But since then, their margin has expanded, and they've shown positive signs about kind of how they're going to execute on their recent acquisitions in the future through their R&D leverage that we talked about.
When you guys talk about your R&D point, you benchmarked Edwards R&D as a percentage of 2024 revenue, and it was a lot higher than all of these competitors. But when you benchmark it in terms of actual dollar value, Edwards is actually spending a lot less. So does that worry you at all that they're just going to get outspent by some of these monster healthcare companies?
No. So if you look into Medtronic, Boston Scientific, and Stryker, Medtronic and Boston Scientific specifically are they're in general surgery, they're orthopedic surgery, they're across so many different types of surgical segments that the real value that they're spending on specific cardiovascular surgical R&D is actually around I think it's around 3.5% for Medtronic, and then it's a little above 5% for Boston Scientific. So I'm not going to do the math for the amount, but all of that 8.5%, 9.9% isn't going into the same type of R&D leverage that Edwards is.
I think that kind of really hones in the point that the advantage of having a pure play structural valvular therapy company is they're able to really push the pedal as far as they can in their advancement market.
In terms of how they get new products to market, how much of that you expect to come from their own internal R&D?
Yeah, so I can speak on that a little bit and I'll open it up to them. Their R&D cost covers their education for those physicians, which is a pretty significant barrier to entry. But also, we're recently seeing their SG&A kind of take off a little bit, which has constrained multiples in the short term because they are really putting a large emphasis on selling these new therapies, particularly in TMTT. Once we get them to market and once we establish them, you'll see the margins kind of re-expand, and that will also come with kind of economies of scale for production and distribution of those therapies, which also supports their margins, kind of leading down to a better bottom line. I don't know if
I'd say their share of their critical care unit recently and their low leverage kind of puts them in a pretty strong position for future acquisitions. But that being said, the future for R&D is, I think, very, very strong as well.
They have a very strong commitment to also utilizing the base and relationships they have with hospitals and physicians that already exist. As they were first mover on TAVR in 2011, they have a really established network with medical professionals, and their name holds a weight in that.
I think it's probably an industry question, but in terms of the reimbursements that this company's receiving, who's the largest payer? Is it basically Medicare?
Yeah, so it's Medicare and insurers, especially for the severe cases, this is considered like a life-saving procedure. So insurance always covers it. And what I'll say to that is TAVR is a replacement for a previously surgical procedure. And the surgical procedure is a lot more expensive. It comes with a lot more risks, a lot higher recovery time, longer hospital stays, or longer bills or larger medical bills for these insurance for like insurers to cover. So this is much less expensive option. But yes, and
For reference, a full SAVR, which is a surgical aortic valve replacement, you're looking in the numbers of hundreds of thousands of dollars per procedure versus a TAVR will run is, the average price procedure is like $45,000.
Where'd you guys get that 0.75 equity beta from?
It was we ran a regression for a 3-year, 1-year, and 10-year beta, and that was our kind of combination of the three of them.
You guys talk through your like ASP and volume assumptions that you made when forecasting free cash flows?
Yeah, absolutely. So, kind of looking at where the market is right now, I know for a fact that that's Houston Methodist in Houston has done a total of like 6 of the new Evoke procedures. So it's kind of like, it's a very, very new to market thing. So we're estimating around globally around 1,500 in 2025. So this is their first year of finally actually doing these procedures. As far as TAVR, we kind of highlighted that the market is kind of discounting the rate at which TAVR is going to be expanding. So, we're kind of factored that back into our assumptions. We did assume that the ASP itself is going to be decreasing for Evoke over the next several years. It is brand new to market. And then that that Pascal and TAVR will, have kind of slight increases in line with the rest of
them. You guys did a very good job of cracking another really tough nut. It looks like, if I'm understanding this correctly, like the one of the main parts for the thesis is the fact that the asset is mispriced, is trading a few terms of revenue and EBITDA below. And because of their R&D backlog and the different successes that they've had with the different outcomes over the past 2 years, like you project that going forward. Okay, got it. So my question is like really on thesis 3A, where you talk about the Pascal system and how it's better than the MatriClip system. Like it definitely looks better when you look at it clinically, but how do you turn that to sales, and like how does it actually turn to sales? Are clinics and hospitals actually switching over from Pascal to AMET? Is that something they're seeing as well?
Sure. Yeah. So
what does that look like?
Yeah, absolutely. So I think the market's perception of switching over is, it comes with training costs for physicians. It comes with, the additional purchasing of some equipment, but that is, highly inflated to what it actually ends up being in reality. In reality, Edwards does cover a lot of the transition costs. And on top of that, like I said, it's an economies of scale kind of issue, over the, thousands of procedures that end up being performed. Pascal does offer some cost effectiveness in that nature. The fact that, it requires fewer units per procedure on average, to help, achieve the same more powerful effects. So I think it's an issue of, kind of just being over discounted. Transition is not something that is a huge barrier.
So they cover the initial cost, and over the long term, the patients that use Pascal over MatriClip have to go back to the physician less.
Yes, that's correct. That's correct.
That makes sense. To add on to that slightly as well, the reimbursement rates for these are flat regardless of how many clips that it requires for that procedure to take. And so as a result of Pascal's system requiring on average less clips to actually complete the repair, whenever you get a flat reimbursement rate, it's going to eventually compound to a much cheaper clinical procedure for the hospitals because they're using less volume and they're only getting the same replacement. It doesn't matter. To clarify that, it doesn't matter how many clips they use in the procedure. They still get reimbursed the flat rate. So with the lower volume and clips that actually need to be used for the repair, it's going to lead to better margin for the hospital, ultimately providing financial.
Awesome. Thank you so much. Appreciate it. Thank you all so much for being here tonight. I just wanted to reiterate how these are all freshmen and sophomores, and they, started this in August. And put all these together from scratch. I mean, we're just helping them with the ideas, but they are truly doing this. Props to all of them. I'd love to give all of them another round of applause. Thank you to Delaney for setting this up. Really appreciate the turnout. It was awesome, and I think they really, our analysts certainly appreciate sharing all the hard work they've done. So be sure to rank the pitches, give us a shout on the website, but we'll all be up here if you want to interact or ask any questions. But yeah, have a good one. Thanks for staying here till 8:30.
You're coming?
Like 3 year, 1 year.
Right. That's my favorite way to do work.